Everyone assumes the next global financial collapse will start in the West. A Wall Street bank fails. A US debt auction flops. The dollar finally cracks. But what if that assumption is wrong? What if the next major shock doesn't begin with panic but with silence? No crash headlines, no emergency summits. It's just a slow, deliberate withdrawal of $8 trillion that Western markets are quietly addicted to. Here said the uncomfortable question almost no one is asking. What happens if China stops playing the game the West depends on it to play? Not tomorrow, not loudly, but methodically. Because if you trace the incentives, the balance sheets, and the power structures, one thing becomes clear. If China executes this move fully, Western markets don't need to collapse dramatically. They will suffocate. Let's break this down step by step. How the West built a system that needs CHEINITE to understand why this matters. You need to understand a basic but ignored truth. The modern Western financial system is not self-contained. It is externally financed. For decades, the US and its allies ran persistent trade deficits, importing more than they exported. That gap had to be funded somehow. China became the solution. After joining the global trade system, China accumulated massive trade surpluses. Those dollars didn't disappear. They were recycled back into Western financial assets. US Treasury bonds agency, debt dollar, reserves Western equities, and real estate dollar-based settlement systems. This wasn't charity. It was a bargain. China got export-driven growth and industrial dominance. The West got cheap goods, low inflation, and artificially suppressed interest rates. This system only works if China keeps recycling its surplus back into Western assets. That recycling pool is now over $8 trillion in scale across reserves, foreign assets, and indirect exposure. And here is the twist most people miss. China no longer needs this system as much as the West does. Why China started looking for the XIT, the first cracks didn't start with geopolitics. They started with risk awareness. From China's perspective, holding trillions in Western assets creates three structural vulnerabilities. Currency risk. The dollar is not neutral. It is a political instrument. Inflation, sanctions, and financial weaponization erode its real value. Sanctions risk crucial prove that reserves are not truly owned if they can be frozen. This was a red line moment for Beijing. Yield risk Western debt increasingly offers negative real returns. China is lending purchasing power and getting inflation-adjusted losses. Once you see reserves as a liability instead of an asset, the strategy changes. China didn't announce a withdrawal. It began restructuring exposure. Quietly. The $8 trillion repost Saidio and Aratayo. This is where the so-called $8 trillion move actually happens. No, it's not one single transaction. It's a portfolio transformation. China has been reducing net purchases of US treasuries, letting bonds mature without reinvestment, increasing bilateral trade settled outside the dollar, accumulating strategic commodities. Instead of paper claims, painting yuan-based payment infrastructure, encouraging sovereign partners to bypass Western clearing systems. This is not a crash strategy. It's a liquidity reallocation strategy. And that's what makes it dangerous for Western markets. Because Western markets don't just rely on demand, they rely on continuous marginal buyers to absorb debt issuance. China has historically been one of the largest marginal buyers. Move the buyer. The system doesn't explode immediately. It reprices. Where cause meets EFFSIT here, the mechanical reality. Western investors underestimate if a major foreign holder stops recycling capital. Three things happen simultaneously. Bond yields rise, governments must offer higher rates to attract buyers. Asset valuations compress, higher yields reduce the present value of stocks, real estate, and growth assets. Currency pressure increases. Less external demand means more internal monetization. None of this requires panic. It requires arithmetic. The West is running record deficits. Issuance is rising. China is no longer absorbing supply. Someone else must. That someone else becomes domestic savers, central banks, or inflation itself. None of these are painless. Why markets won't crash? They'll ROT. This is where the title needs correction. This is not a cinematic collapse. It's worse. It's a long period of lower real returns, higher volatility, persistent inflation pressure asset bubbles, followed by shallow crashes, declining purchasing power masked by nominal gains. Western markets are optimized for liquidity abundance. China's move introduces liquidity scarcity, and scarcity doesn't cause explosions, it causes decay. Japan already ran this experiment. So did late-stage Britain. So did Rome, just without Bloomberg terminals. Why policy responses won't work every time this pressure builds. Western policymakers reach for the same tools: rate manipulation, monetization, regulatory distortions, moral hazard bailouts. These Dantes solve the problem. They postpone and enlarge it. Why? Because you cannot replace a foreign surplus recycler with domestic debt issuance without consequences. You either pay higher interest or debase the currency. There is no third option. China understands this. That's why it's exiting slowly, letting the system weaken itself. Modern parallels, the pattern that never changes. The historical pattern you should be worried about. Empire runs trade deficits, foreign capital funds consumption, financial assets inflate, external funding slows, debt monetization accelerates, real returns collapse, trust erodes. This pattern has repeated for 500 years, different currencies, same math. The dollar is not immune. Western markets are not exceptional, they're just late in the cycle. 3 takeaways. No comfort. Just CLRTY. Takeaway number 1. China's $8 trillion shift is not an attack at S risk management. That makes it more effective. Takeaway number 2. Western markets don't need a crash to fail. Prolonged stagnation and inflation do the job quietly. Takeaway number 3. The real danger isn't China's move. It's the West's dependence on a system that assumed China would never leave. The question you should sit WITH, the real question, ISNT, whether China will collapse Western markets. It's this. What happens when the world's largest creditor stops believing the system is worth saving? Because when confidence disappears, liquidity follows. And when liquidity leaves, narratives don't matter, balance sheets do. If this changed how you see global markets, don't just scroll away. Subscribe, because the next video will break down who absorbs the shock when China fully steps back, and why retail investors are always last to know. This isn't about fear. It's about understanding the system before it understands you.